Good morning, everybody, and welcome to Series 3, Episode 4 of Crystal's Complex Cases. I'm Dan Morris, Key Account Director at Crystal's Specialist Finance, and as always, I'm joined by two very special guests, two of my three amigos. So we've got Roger Morris, Sales Director, Mortgages at Tandem Bank. Good morning, Rog.
Morning, Dan. How are you? And good morning, everyone. Thank you for joining us again.
Absolutely. I'm good, thank you. How are you?
Yes, we're all good. And we've got the legend that is John McCaffery. Morning,
Good morning.
John.
How are you?
Himself. Good morning, John. Well, thank you both for coming on. As always, I'll set the scene here. So for those of you that have been repeat offenders joining these sessions, thank you very much for joining again. We appreciate your support. And for the newcomers, welcome. You're in for a great session. As always, there's no format for these sessions. It's all about you, what you want to know, what questions you've got, and it's just going to be a conversation between the three of us and yourselves around the current market conditions, market forecasts, which obviously there's a lot going on, as there has been for the past 15 months, and we'll just see where this session takes us. That's the beauty of it. No script at all. There has been a few pre-asked questions in prior to this, so thank you very much. But I just can't believe that we're in August already. The sun's finally shining again, which is great. We've had a wet and gloomy few weeks. The kids are off and we're gearing up for Q4 on the end of the year now, which is just ridiculous, isn't it? But how's it been for you two over the summer, the past couple of months? Obviously, the market again has changed. Things, touch wood, seem to be settling again. We said that last time and then it didn't. The market went into turmoil. But how's it been, Roger, at Tandem for the past couple of months?
So I think when it comes to where we've been with Tandem, it's been really interesting to see that volatility within interest rates and how it's dramatically affected and reduced the chances of the dreams of home ownership, Dan. So if you take the world that we currently offer, is we realistically, most of our volume is done on first charges, is to do with those customers who've got some form of adverse, and therefore the interest rates now have gone up substantially, which impacts affordability. And actually the chances of them being able to get that dream home has been that one step further away. Our second charge division, which really works on more prime customers, that's seen a massive increase, Dan, massive increase. Because say you want to extend your house, maybe you've got a baby on the way, you don't want to buy a new build, you might want to extend, you've got a cracking fixed rate paying 2%, then a second charge is something to think about. But also I've been inundated with questions about what is happening with the state of the buy-to-let market, what should I do? And we've got a number of questions, Dan, that I think if it's okay today, I'll pose to you. But I also would just like to sort of say congratulations to you, because you've moved into a new house literally a few days before you expect your second baby. But also just the fact of you've been sort of one of the few that are moving, buying a new house and sharing that.
The trend. We just want more business, you see, so I'm trying to book the trend. So if I do it, hopefully the others will follow suit.
Well done for that, because you are on that green journey anyway, because it's most likely a better EPC. And John, how are you doing?
Very well. Change fuels my business. So people say it goes quiet over the summer. I'm not finding that at all. Volatility creates opportunity for entrepreneurs out there, and they're most certainly taking advantage of it.
John, I can't think of a better time that a tax advisor is needed by a landlord.
Yep.
Because at the moment, if you are a landlord, and realistically, right now, you're looking for a new fixed rate, and we'll come on to this with the questions Dan's got, but this has got to be the time more than ever you just want to pay for your services for an hour or more of your time to go, what are my options? What would you advise? Wouldn't you agree, Dan?
Yeah, no, I absolutely would. I'd agree. And as we say in these sessions all the time, it's all about who your allies are and the people that you've got around you in terms of supporting you and what value they can add to your business, whether it's advisors themselves or clients alike. It's a case of having someone good in your corner that can actually save them a bit of cash and help them with the business prospects, really. It's the same with us. So all these sessions are about, and it's not about plugging us through as individuals and our firms as such. There's plenty out there compliance slide here that can do what we do. But it's just about having allies in your corner. And I think certainly at the moment, from a packager point of view, it's a packager's market. It really is. We're really bagging the drum in terms of getting brokers to link up with packagers like ourselves that understand the specialist market probably more than most people, because it's our bread and butter. We don't do vanilla. It's our bread and butter. And it's an area that we can support. We can educate, like these sessions today, and other sessions that we offer, and visits and actual meetings, so to speak. But it's just about having people in your corner that can add value to your business and increase your turnover. Because I've said it from the beginning of the year, if you want to earn as much as you did last year, if not more this year, how do you do that? It's the ancillary pieces that John does. It's the specialist finance cases that we do. It's the stuff that may have historically been out of your comfort zone, but actually now, if you want to excel and increase volumes and turnover and income, essentially, then you need to start thinking outside the box now more than ever. And again, that comes back to your point around second charges. A lot of people historically, and still to this day, do not and will not do second charges because it's not a solution they see as not so much viable, but they want to get involved in, really, because it is complex, but it's a solution that needs to be considered now more than ever, with the way rates are going and the way the market's going in terms of clients' needs, wants and expectations, whether it's, as you say, debt consolidation, home improvements, tax bills, school fees, weddings, things like that. But there's just so much to consider at the moment. So again, using allies and people around you like John, like us, like yourself, then it's just adding value to your business, really. So yeah, but I mean, like I said, in terms of Crystal at the moment, we're busier than ever. We really are. So going back to the past couple of months, we're getting more and more new users using us and dealing with cases that actually historically wouldn't have touched, but they've had a feel for it and realize it's not actually that scary. But on the flip side, for them, from a personal point of view, yes, you're helping the client, which is great. And again, you're doing a case which someone else will decline. Certainly the bank will decline, but actually the incomes are pretty good as well. So it's a double-headed win because the client's getting helped and it's better financially than the mainstream sort of cases. So yeah, but most of the questions that we've been asked today have been around buy-to-let, as you've said. So I think the buy-to-let market is in a bit of turmoil. I think we probably all agree with that, whether it's from a tax point of view with John, people offloading or considering different options, or even people now which historically are coming off a fixed rate and they're not able to move to a different lender because of the stress testing at the new rates. So there's lots to consider at the moment, isn't there? I think you'll agree with that. Yeah, so let's get straight into the questions. And guys, I'm going to do the questions today because I actually think from a lot of these, I think it's brilliant to get Dan and Crystal's view, because a lot of them really are specifically for Dan, and then me and John will obviously come in with our points raised. So again, in the chat facility, and I'll say this time, in the chat facility, as your questions come to mind, please put it in and we'll answer live as we go. So the first question, good morning, Terry Arch. Terry's question or observation, Dan, this first one's coming for you. Is it, Terry, or is there a decline in bridging cases getting through because of higher interest rates? No, see, I'd probably disagree with that, Terry, if I'm honest, because we've seen probably maybe a 30 to 50% uplift on bridging cases that were getting in and getting over the line this year alone. Now, if you look at where rates sit now, as opposed to 15 months ago when all this started, the term loan rates and bridging rates are pretty much, I suppose, in line with each other. It's not that hard sell anymore, where rates were, 10% and buy-to-let rates were 2%. They are more and more in line with each other. The bridging market hasn't been affected and impacted as much as the term loan stuff, because if you look at the swaps markets rates-wise, you haven't got that long term. It's a 12-month term max realistically, and it's paid back. But we're seeing more and more landlords, investors that are purchasing properties via a bridge because they're edging their bets as to where the market's going to go. Everyone seems to think that the markets are going to settle and rates are going to stabilize and even drop over the next 12 to 24 months. So we're seeing a lot of investors and individuals alike that are actually purchasing properties via bridge, whether they're doing up the works and then seeing where the market's going, if there's an uplift in value selling or refinancing. So from our point of view, I'd say the market's busier than ever on bridging finance. I really do. So we haven't seen an increase in declines. Obviously, there's been a shift in terms of rates, but the shift in terms of rates has been negligible as opposed to the term loan stuff. So it is now more appealing to individuals, businesses, whatever, to actually purchase and use a bridging loan or short-term finance facility. And a lot of people at the moment want speed. So it all depends on what that particular individual priority is. But no, I think I disagree with that comment there, because we've seen an uplift in cases getting across the line and interest in bridging finance.
So Terry, the simple answer is, if you have had cases being declined because of that higher interest rate, it's certainly worth taking that crystal challenge and seeing the experience that Dan and the team there can go. And that, Dan, some of your responses back, and thank you for that, ties into Sabra Aslam's question.
Well, just quickly on that last bit as well. So coming on to our services, obviously we won't be beating on non-regulated bridging. So if it's a case of rate, or even you guys wanting to earn a little bit more, or beating another advisor out there, we won't be beating on a like-for-like deal on non-regulated bridging. I can't say it on regulated because compliance would kill me, so I have to say it on non-regulated. But yeah, if you ever get a non-reg deal in on bridging that you want us to take a look at and essentially beat, then send it across to me or my team. But we will not be beating on non-regulated bridging on a like-for-like legitimate, I must stress that, term basis. So yeah, sorry, go on, Rog.
No. And by the way, I get such great feedback about bridging and Crystal and being like the #1 specialist provider, specifically based on rate and fairness. The next question, which ties in, which I'm going to be coming to you on this one, John. So good morning, Shabir Aslam, for your question and for attending today. Dan had kind of touched on interest rates, and this is the question that Shabir had asked. Buy-to-let mortgage deals for 2 or 5 years, which is the better one? And John, what that ultimately means is, where do you think interest rates will go, settle to? What will become the new norm? Would you go for a 2-year deal because rates are going to drop and then go for a 5-year deal? Or would you do a 5-year deal? What's your view on interest rates and the view on how you would go? If not giving advice, but how you would go?
Yeah, I can certainly answer the first part. I get into a lot of trouble if I even touch on the second part, I'm afraid. I speak to a lot of economists because interest rates and tax are just 2 tools being used by government in order to manage the economy. Not harping back to it, we spent a fortune in COVID and we threw new money out in COVID as well, which brought more money into circulation and a greater reliance on the state. Coupled with the fact then, because there was more money in circulation, there was more demand on supply, prices have gone up, right? And the government, the bank has been putting up rates in order to reduce the supply of money available. The problem is, we're still doing all right. The economy, it's growing marginally. And this talk about a recession, there's some thought that a recession is kind of like a bit of short-term pain to actually drop things back into realistic levels. Wouldn't have been the world's worst idea. Inflation has stayed stubborn because people are still spending and the economy is still growing. And with that as a backdrop, plus you can't really tax too much more. We're on a really high tax burden at the moment. There's not going to be in my opinion, there is not going to be a massive drop in rates. As it comes down, it will normalize a little bit. But the last 15 years of free money, I think, is something that is long gone. I don't know if it's hope value. I do think people would look to get rates back down. Historically, rates have gone up to 15, 16, 17%. We're not in a bad place if you look at the big picture. And I can appreciate that a lot of landlords are feeling the pinch right now, having borrowed on basically really, really low rates of interest. But we need to adapt to a new normal in terms of what the rates of interest are going to be. In terms of what rate would I choose, I can answer in terms of actually it's quite similar to the tax planning. What can you afford? And you have to look at your rates and your tax as a cost of your business, and in your circumstances, tailored to your circumstances, which one suits your circumstances better.
Yeah.
So John, before I come to you, Dan, so John, when you look at interest rates, where do you think they'll peak at? I know this is an absolute guess because every economist has a different bit. Do you think we might see inflation dropping over?
I feel inflation's turned. I've got a lot of friends who are financial advisors. They feel inflation has turned. They feel the markets aren't coming back for a little while. I think it likely, unless we get a bit of a shock, that interest rates have probably peaked.
And where do you think they'll settle?
4 to 5-ish.
Wow. So not that much of a drop then from where
not that much of a drop. It's, as I say, I know people would want it to go back and to free money in the economy, but there's demand on money right now. There's a lot of tax and there is I can't see it going back too much further.
So Dan, I'm going to just re-ask you Shabia's question, but I'm going to give you a slight twist to make it more relevant to what you're doing at Crystal. Okay. So what the question being given was buy-to-let mortgage deals 2 to 5 years, which is a better one, and Dan, with or without a fee. So I was doing a bit of comparison just for my own portfolio today, and I was looking at Coventry on product transfers, and they do have deals with no fees, right? And then I was looking at other lenders like Precise, TMW, Paragon, at LendInvest, where there might be, say, Paragon, LendInvest, Precise with a 5% fee on a 2-year deal. So 2-year deal, 5% fee. It's as if the belief is that at the end of that 2-year, that property prices will have gone up to absorb the 5% fee, interest rates will have dropped. What's your view? What do you think, and what are you seeing the demand for within Crystal?
Well, no one saw this coming realistically. Certainly not to what's happened, to the extent that it's happened as well. And as we keep saying, the Liz Truss effect, using number 10 as an Airbnb, created a lot of mortgage market turmoil, didn't it? So we don't know where the market's going to settle, because John's got an opinion, I've got an opinion, you've got an opinion, and everybody out there has an opinion as to where rates are going to settle. And that particular question is 2 or 5 year fixed the best thing for that client. It depends on that client's circumstances. 5 years, realistically, you're always going to get that larger loan amount. Now, for some people, it's always about the loan amount, the stability and the rate, so to speak. But for others, there might be more, I think they're more switched on and think, actually, we'll go for a 2-year fixed. But because the market's going to settle, we'll get a better rate in 2 years, or actually linking back into what John does. We might look to sell in 2 years. So it depends on where the market's going to go and if we want to be in or out of this. And obviously with the 2-year fix at the current stress test, certainly at a high rate taxpayer, you don't get anywhere near the loan amounts you would in a 5-year fix. However, coming on to what you said there, those on a 2-year fix with the 5% arrangement fees to drop the rate, so to speak, it really depends. There's no one size fits all. And obviously you've got lenders out there as well. So obviously this is linked purely to the regulations that came into force in terms of affordability and stress testing. You've got lenders out there which aren't banks, so they aren't essentially aligned to the regulations by the PRA. So with that, you get those that are still stressing 2 and 5 year fixed rates at 125, meaning the loan amounts are going to be negligible in terms of the difference. So there's lots of factors and external influences that are involved in that question, but I think it's a case of getting what the client wants and what's important to them. Similar when you're doing a recommendation on a residential purchase, and then either doing your market research or coming to someone like us with all the facts, and then we can not so much make the recommendation because it's down to you to recommend, we'll give you options on the table as to what could be the best possible solution for the client. So I know I've kind of dodged that question there, but it's not one size fits all. It's really not one size fits all, is it? It's down to that particular client's circumstances. But ultimately, if you think the market's going to stay the way it is, I'd probably recommend, if it was me, a 5-year fixed standard. If you think the market's going to drop and change, then you're probably going to be looking at maybe a 2-year fix with one of these higher rate lenders where they're not PRA regulated and you haven't got these high fees, because realistically everyone sees that there's going to be a correction in the housing market as opposed to a drop or a crash. But ultimately, is that going to justify not paying that 5% fee for the better rate? So there's not one size fits all, unfortunately. It depends on client circumstances.
So what my advice would be the following: if you are recommending a 5-year or a 2-year deal with a 5% fee, specifically a 2-year deal, you need to make sure you document regarding that 5% fee or the 7% fee, and you need to document what the revert rate is. So I was looking today, if you look at some of Precise's revert rates, it's 9%. If you look at Paragon's revert rates, it's 9.35%. Just depends. Some of the deals that they have with the 5% fee, they actually have a revert rate at 8.10. And it's about the guarantee and the ability to get a product transfer. If you're doing a purchase and you're looking now, 7 out of 10 landlords are limited companies for 2 reasons. 1, you're going to 100% offset the interest. And 2, it's the deposit. So if you've got a 60% purchase on a 200 grand property, you've put in 80 grand of cash in. If that's in personal names, you're not going to benefit from that 80 grand that you're putting in. You're not able to really sort of extrapolate that value. When a limited company is a DLA, you're able to get, I think it's 2.5% over base rate, which is a notional interest rate that the revenue apply every April. I'll just check in with John. In fact, I'll check in with John now. Would that be right, John? It would be 2.5 above the 5 is what you'd be allowed to be a fair value of interest rate at the moment.
They've actually just capped it at the 2.5.
The what?
So the benefit in kind charge is based on, I think it's 2.5% rate. They haven't actually moved it up.
I haven't. Oh, mine's that was April of yes, but I dare say next year that will change.
I imagine the rate of interest from the revenue on all of the taxes is actually stacking above base rate quite highly.
Yeah.
Benefit in kind charges on the DLA still one of the few things actually has got a decent rate on it.
Right. So it's a question of, again, where your equity position in a limited company is another factor you got to think about. Or even in personal names, if you're taking out 80 grand out of your interest account, if you take Tandem Instant Access at the moment, it's 5%. That's 4 grand a year you're going to lose of income by putting that cash in. So you've got to really start to think about, in this higher interest rates, what that equity position is. But the more equity you put in, the cheaper rates that you will get. Coventry have launched a 50% range now, which is the first time we're starting to see 50% deals coming in. It used to be 60 or 65. And that's because of both the affordability play, in other words, the security of that return coming into place, and also attracting the lower risk buy-to-lets. The 80% deals at the moment, you really do have to factor in to their ability to be profitable, specifically if they're in personal names. The other factor is looking right across your portfolio. So if you've got, say, 10 buy-to-lets and a residential, and maybe your residential's unencumbered, could you obtain funds cheaper on your residential, which you can still offset in your tax return, and being able to blend out your portfolio, say 60% across it all, to be able to get those cheaper rates? Or you might decide to sell 1 or 2 older properties, being able to take that capital out. Yes, you're going to pay your capital gains, but then you could then position that in personal names back into your portfolio to reduce your overall indebtedness. This is why I think you really need to speak to John more than ever. But my personal view, I would never take any mortgage product with a 5% fee. I just wouldn't. So when I'm doing remortgages, and particularly looking at the product transfer offering, it's lenders like TMW and Coventry, which I've checked out today, where there is no arrangement fee. In other words, you're not increasing your capital balance, particularly if the belief that property values are going to remain stagnant or reduce over the next 2 or 3 years. John, do you want to pick up anything on that from me, or you were relatively happy before we got the next question?
I'm relatively up. The DLA thing you're talking about, just a little bit of clarification, just check that the official rate is now 2%, which is a bargain rate on 2%. What you need to be a little bit careful of is like borrowing from your company and that kind of thing.
Yes.
Someone called it's called a close company charge. So if your loan is outstanding 9 months after your company year end, you have to pay an amount equal to 33.5%, 0.75% over to the revenue until the loan is repaid. So it's not, whilst the benefit in kind rate is quite cheap, the costs actually quite hefty in terms of cash flow.
Yeah, the old concept of bed and breakfast thing. Dan, the next one from you comes, good morning, Penelope. What Penelope was asking is, do you think we're going to see an easing of stress tests on buy-to-let?
I mean, well, first and foremost, let's discuss how all I'm seeing behind you is Tandem, but all I'm hearing come out your mouth is Coventry. Is there something you need to tell us?
No, it's a good point. No, I think at the moment we're looking at restructuring a number of our deals, and I've been helping 2 or 3 friends. And my situation, one of my best friends, Dan, he had a 19th century Victorian 2-bed terrace property. Concerned about the EPC changes, and every time people move out because of the old plaster and things, there's always work needed. The tenants have given notice they were paying $695, and the answer was, let's just sell it. But the letting agent's been on the phone that they can immediately re-let the property for £975 a month, no work needed, and the property can go straight back out. And that particular friend was with the Coventry Building Society, and what I liked was the fact that there's an offer where there's very low fees. I mean, you can sometimes look where it's £2,000 and you think, well, percentage wise, what does that work out? Maybe 2% on 100 grand average sort of buy to let value rate mortgage would work. But it's just at this moment I'm particularly against large fees, because I think it's done because of this question Penelope's asked. Is the stress test doesn't work, it doesn't fit. The only way to make it fit is to get a low rate. The only way to get a low rate is to pay a big fee. But what happens then? Have you got entrapment that in 2 or 5 years' time, you've got no chance of going anywhere? And is that a chance of a complaint coming back from the landlord to the broker for the advice given? Because I cannot see any chance of reducing stress tests, particularly when reversion rates are between 8.25% and 9.35 at the moment, just as a general average, Dan. So what do you think on stress test rates and the Coventry?
Coventry, yeah, great team. I like them, yeah. I don't think we're going to see any change in stress testing at all, because it was brought in, and I can't see that being modified or removed, to be honest. So I think it's a case of it is what it is, really. The regulations were brought in to essentially protect. Is it protecting or not? But no, I don't think we're going to see a shift in that or a change in that at all. I think it's here to stay as it is. And again, if you're looking, or if it is causing issues, then it's about where do you go with that particular deal, or do you go to these non-regulated lenders that could offer you potentially more money, because obviously stressing comes down to the money that's available for the loan amount. But I think another part of that question could be, do you think we could see more help and support from lenders when a deal ends, in terms of mortgage prisoners, to be able to easily PT onto a different deal? Because obviously some lenders don't offer the PTs, do they? It's a case of, right, you're going on the SVR and it is what it is, sell it or don't. But unfortunately, you are a mortgage prisoner. Do you think more support will be offered?
No, I don't. I don't think they can do it legally. So if you take some of the challenger banks that are out there, you know, Lend Invest.
Coventry?
No, not Coventry. There's a number of the challenger banks, Dan. Quantum, I'm just trying to think of them all quickly. They get their money from securitization. So when you've got to think as the advisor, if you're putting me as a landlord, right, I'm going to pick this challenger bank, and it's a 5 or a 7% fee. So your LTV is going to go up between 5 and 7%. And at the end of that fixed rate, 2 or 5 years, what is the revert rate? You've got to explain that landlord and show that landlord what that payment would be at, say, 9.25%. And if the rent doesn't cover that, which I'd be very amazed that it does, how are you going to justify that? Because putting them with a challenger bank, and because of the securitization, they are restricted and not able to offer product transfers. That customer, because you've recommended them increasing their LTV and increasing their expenditure and reducing their profitability, will be stuck with that lender, Dan. And I think you're going to be very careful. You have to work out that next step.
I was going to say, would you say it's fair to say then that it's not about the here and now, it's about the 2 or 5 years time in terms of what can be done if PTs are available with that particular lender, or what sort of position it puts the client in longer term, as opposed to, right, let's get this done now and we'll worry about it in 5 years time?
Yeah, I can just see entrapment and claims management coming through by saying, you knew that the buy-to-let didn't fit any of the lender's current ICR calculations. Now, and be very clear, in personal names, the ICR calculations should be 125 if you are including your rent, a basic rate taxpayer, about 140, 145 if you're a high rate, and 160 if you're a top rate, because that's ultimately the tax you're going to pay. Limited companies have the lowest ICR. Why? As John will explain and has explained, it's because they can offset their interest relief. But if it doesn't fit now in that current legal structure, by increasing interest rates with the expected property decline interest rate market not really going to change that much within a 2-year period, and that lender you're putting them into doesn't have product transfers, it's a real problem. And that's my concern, is so many advisors are doing a deal today without evidencing the consequences of the reversionary rate impact, Dan. And that's just, and Harvey, thank you for confirming me and you are on the same page. But Harvey, you've asked a question. Dan, do you mind I just go live to this one to John? Is right, John, I've got me and Dan, we've got 3 buy-to-lets between us. Yep. And we want to incorporate, because if we incorporate, we'll be able to offset the interest and we'll be profitable again. Can you just sort that out? Because
I can sort that out, but you need to have a little think around whether you can afford it. Yeah. So
it's not easy. It's free. Harvey,
it's not easy. No, it's not easy. It's but I think also that the point that you're making around these remortgaging and mortgage rates, before you get your new mortgage, you really need to think about your structure. Yes. You really, really need to think about your structure, because if so, entrapment. So you're trapped by the mortgage, and then you can't alter your structure, so you double down on your entrapment. Yeah. Whereas actually, if you can think about how you structure the arrangement, interest is one cost in this. People always forget the tax, and tax is the most expensive thing that will happen during your life. You pay tax everywhere, everywhere, right? So disposal of your property, you pay tax. Buying of a property, you pay tax. On your interest, it increases your tax if you can't relieve it. You pay interest, and it depends who you pay it to, you have to withhold some tax. It's everywhere, everywhere. Your expenses, you can either tax relieve them or you can't, depending on the type of property you've got. Yeah.
Yeah.
And unless you've got your structures right, you are adding to costs at a time when costs are already really tight.
And really. John, I'm still seeing lots of. I was this couple of friends I'm helping. Both, one was high rate, one was basic rate. Neither of them had done tenants in common, and they hadn't gone through that whole process. And that week, I could sit down on a bit of paper and go, very simply, this is how it works. And well, why didn't the accountant tell me that? Because the accountant's, it's not the job. This is where you need to set to your tax advisor. And then it's always the same old question. Well, what will that cost me? It's not what it'll cost you, it's what it'll save you. So Dan, sorry, go on, Dan.
No, I was just saying, absolutely, yes.
It absolutely is. Yeah. So it's a question of, if you want to understand incorporation, or you want to understand the solutions between joint tenants, tenants in common, trusts, and being able to incorporate. And now, Dan, we are seeing, again, according to the stats that come out today, 7 out of 10 people going into a limited company. I love them because I really understand how they work. And I think more education is needed in this industry at the moment. So the next one was from Femi. Good morning, Femi. They want to know more information on affordability. So Dan, do you want to maybe just give a generic coverage of affordability? I think with more a residential focus now, because we are seeing as interest rates rise, the average affordability is 4.5 times. How are you seeing that? I know your sort of big area is resi mortgages for you guys, but it's an area you are growing.
Yeah, it's an area that we're doing. I mean, we predominantly see it if it's a case of a self-employed client, adverse credit, unusual property types. They're kind of the 3 main areas that we would get involved in. Obviously, a residential deal. Don't want to do vanilla because there's no reason for us to do a vanilla deal or get sent a vanilla deal, essentially. But yeah, you bang on. I mean, most people realistically are at 4 to 4.5% from an affordability point of view. But generally speaking, that doesn't cause an issue. It's the self-employed where we're seeing the biggest issue, and the lack of common sense from the lenders. I do think more can be done by lenders on the self-employed stuff. So we've seen a lot of products, well, not a lot, that's a lie, a few products come in recently where they'll help the self-employed clients with their income plus share of profit, which a lot of lenders aren't doing now. And more lenders are looking at just 1 year's accounts rather than averaging 3 years accounts, and discounting downward profit turns and stuff. So yeah, but in terms of affordability, again, it's one of those things, regulation that's being brought in really, which is to protect the client from not being able to borrow more money. So standard across the board, it's 4.5%. Realistically, that doesn't change with any or many specialist lenders. Some may go to 5 times if you're a hero, so to speak, so NHS or armed forces, but ultimately it's the same across the board realistically, and it has to be. Now, if we look at second charges, obviously with second charges, there's a lot more flexibility there in terms of income and the affordability piece, which most second charge lenders, you can go up to 6 times income. So it gives you that extra lending should you need it and require it. Obviously, it's a mass market that you're massively in, isn't it, Rog? But from affordability, it's the same across the board, whether it's in mainstream or specialist really. But yeah, there's just more common sense that's involved in that specialist sector.
Yeah, and yeah, Dan, honestly, you answered that really well. And Femi, just to kind of build on what Dan's doing, what I'm doing throughout September is myself and Mark Shelper, every Tuesday, we're running an hour's session just on the key components around assessing affordability and creditworthiness. So we'll do a session on bank statements and how to read bank statements. We'll do a session on how to read a credit file and really be able to extract the right information. So in other words, when people take cash advances on a credit card, it's all in that credit data. And a lot of people have never really spent that time to forensically understand and been able to reap the rewards for good advice. And then it's going to be how to read accounts. So I've created a set of accounts where we'll be able to really be able to break down that income. So at Tandem, we need 3 years accounts, but we'll work off the most recent year's income. A lot of lenders are proud to say they'll work on 1 year's accounts, but that first year, there's never really the income there to be able to make that affordability because they've written off what they can. Second year is normally a kind of a stepping stone forward, and it could have covered the COVID period as well. What we're seeing is by having 3 years accounts and being able to break down in that income. But the other thing that we do at Tandem is we send out an accountant certificate. Because if you've got, and we always insist it's from a proper qualified accountant like John or John's firm, where that accountant will tell us their income position. That's worth far more than a set of accounts because a chartered accountant is qualified and has to tell us the truth. Their certificate is of the significance equal to a solicitor. So we're able to make that informed affordability decision. But you've got to really factor into, and specifically where affordability will be the highest on residential is a 5-year fix because of that stress testing. Stress testing has come down now because it was built in over the last 17 years for this rate rise, but you've still got to be comfortable that if there is any more volatility in the marketplace, which nobody can predict, it is there. So again, if you want some more advice or you want a bit more understanding about all those aspects, look out for the educational programs. They'll be on catch up, they'll be downloadable. They don't have any particular lender spin. They are really good. So Dan, I'm going to come back to what I think is the biggest question we've been asked at the moment. And this specifically is for you, and maybe something that you could even do a further webinar on, was Christina Matthew. Good morning. Your question is, you would like to gain more knowledge about handling complex cases and things to look out for. And Dan, I'm seeing that more and more as the number one's specialist packager and distributor. And that's without question. Anybody else listening in, the facts are the facts. What could you do to give an observation now? But is this something that we could maybe run as a one-off? And sure, with David's listening, where you do a one-off session on approaching, assessing, maybe marketing for or attracting specialty cases, and then how best to help them. So do you want to, maybe this is, I think, the best question. Not the other questions were good, but I really do like this one.
Thank you, Roger from Coventry. Yeah, do you know what? We're getting asked that question a lot more now. We really, really are. So when my BDMs are having meetings, I'm speaking to my firm, so to speak, or even our telephone account managers are having conversations. People are actually interested in the specialist market, which again, 2 years ago, no one cared about it really. There was a small handful of brokers, maybe 10% of the overall market, that actually looked for specialist business and did specialist business. But now, again, as more and more clients, certainly since COVID, and it's just snowballed, are becoming specialists for any number of reasons. It's a market that can't be ignored now. It's growing. Typically, the high street is saying no to a lot more stuff than they were previously. They're tightening the belts, and you know, they've got great mortgage books, but they have that option to say no. And unfortunately, whether it's an existing client that's referred you or a new client that's come to you, you can't afford to say no to these clients. You really can't. So we can offer an array of support. So you've mentioned a great suggestion there in terms of a specialist lending webinar where we can just go through the different sectors, so to speak. But ultimately, whatever support you need, we can realistically offer you. So whether that's marketing tips, Dave will be rolling his eyes now, sorry Dave, or sales tips, or again, just key things to look out for that particular sector in terms of what can be placed. But ultimately, anything in this marketplace can be placed. It's just about knowing who to place it with. And again, it's about choosing your allies. So if it's a case of you actually want, anyone on this call wants to learn more about the market, and that's not about placing it through ourselves, then we've got pre-recorded webinars we could send across to you. We've got sales documents that we could send across to you in terms of what to look for and how to look for it, and what fits LTVs and stuff like that. So again, we've got an arsenal available for advisors that ask for it and that want it, and we offer it to them. So it's just a case of what works well for you, whether it's face-to-face interaction, whether it's webinars like this, whether it's sending you pre-recorded sessions, like a podcast, so to speak, whatever that is, we've got it available. It's just how you best learn and want to learn, and I suppose increase your knowledge in this specialist market. So it's something that we are, as a business, very enthusiastic about and very passionate about, and that's about educating the market. If we get business off the back of it, brilliant, but it's our way of giving back, so to speak, and helping more clients out there. So yeah, but I think you made a good point there in terms of running a session. Otherwise, it's a case of if you want to learn more and earn more, most importantly, then speak to us and we can get that set up in whatever environment you want, whether it's face-to-face, over the phone, via Teams, or even sending you some documents and literature across. But yeah.
Dan, thank you. Christina, what I would say to you now is, if you are communicating with your customers, your entire database, you should be doing that once a month. The ultimate and optimum time for click-through rates is a Sunday morning at 10 o'clock. And what you want to do is be telling the customers out there that if they or their family members believe they are not able to purchase a home because a high street bank said no, then contact you. And what I would do is learn on the go, attract the specialist cases in, don't overthink it.
Sorry. See, you don't even have to physically get involved. So with
No.
people like ourselves, you've got that referral option. So it's a case of you
That's
ask the
what I was
basic.
going to say.
Yeah, well, there you go. But you ask the basic questions. We don't need War
Yeah.
and Peace or a full fact find complete. It's a case of
Yeah.
right, so Christina's got a client on the phone. She's done the resi for them. They've obviously trusted her with the biggest transaction that they're going to do in their personal life anyway. They're a self-employed client. They own a warehouse or an office, or they're a pharmacist and they're purchasing the store, whatever. You don't have to know the full ins and outs of that deal. It's a case of, I know it's going to be commercial. I don't do commercial. However, I work in partnership with a firm that is outstanding at this. If you're happy, I will get them to reach out to you and take it from there. And that's it. We just literally need client's details, phone number, email address, and a brief outline of the deal. Simple as that. If you want to get involved, then we can absolutely hold your hand throughout that process. And you can learn about, the commercial process, bridging process, development. So then you want to be more involved and be more of an expert in that area. Absolutely. Again, we serve the needs of the advisors. It's as simple as that. We don't have the products as much as we have exclusives available with lenders, and they're not our clients. So whatever service at whatever level you require, then we can offer that to you. And again, we're geared up as a specialist introducer to deal with these more complex cases, because it's our bread and butter. So yeah, but you do have that referral or package option dealing with someone like us, where you can have full control or no control. It's as simple as that. So it's just about choosing your battles, and as I've mentioned, choosing your allies. I keep mentioning it, but that's the theme for today. It's about what and who you have in your corner when you need them, whether that's John, whether that's us, whether that's Mr. Tandem,
Or the Coventry.
Yeah, the Coventry. Yeah, absolutely.
Right.
I'll the LinkedIn post later. But yeah, so it's just about how much involvement you want and how you want to be educated. So if you want to learn more, then please do speak to us after this.
So John, here comes the next question from Harvey. Harvey's question is the following: would you agree that some landlords who hold properties in personal names, selling is not an option due to the CGT leakage? Therefore, shouldn't lenders market terms, in other words, the max age at 99 years, like TMW? Just by the way, I used to love this one when I was at Precise, and I used to call it Let to Die, because Precise would go to 115 years. By the oldest living person in the UK is 113. That was why. And what the reason for this, John, is it helps passing down the property, because it's still retained by, say, the grandfather or father. A lot of landlords have interest only, and the loans are going to end at the age of 75 to 80, at which age might not be able to remortgage. Could this be a problem? So if you want to maybe cover off the inheritance tax angle, and then maybe Dan, you want to pick up.
A few angles there. One, if you're talking about passing down on death, maybe. If you're talking about passing down during your lifetime, there's no getting away with the capital gains tax. A gift during your lifetime attracts capital gains tax charge, whether or not you receive cash for it, and it's at market value. Inheritance tax. So property is subject to inheritance tax. There's allowances available depending on how much you are worth at the point of death. There are reliefs available on certain types of assets, but property isn't one of them. Debt against a property reduces the amount that is subject to inheritance tax. So yes, having debt against your property at that time. But on your death, you do then have to find a way of repaying the debt. And if there is still sufficient value in the property above the value of the debt, you've still got an inheritance tax charge to fund.
Yeah.
The other benefit currently, and it's being considered at the moment, is that on death, the historic capital gains are wiped out. But there is, at the moment, consideration being given to whether that benefit should be removed. I don't think it's going to get airtime in Parliament, because there's not a lot of time left in Parliament and there's an election coming up. But for right now, there are certain benefits to retaining debt. Yes.
Dan, do you want to maybe pick up on the fact that you don't have to leave it till you're beyond 75? You could remortgage, couldn't you, at the age of 70 to say TMW Precise or other lenders that will do a longer term, yeah?
Yeah, no, absolutely. Again, as you mentioned, with Precise and that Let to Die product, like you said, then yeah, you don't have to end the term at 75, 80. You've got lenders that will go far past that. It's just about gearing up and not leaving it too late, really, and just, as you said, going through your mortgage book once a month or maybe once a quarter and just understanding your clients, and that will come down to having a good CRM system in place. But yeah, no, there's loads of options out there for these older clients, because people are living longer, working longer, and have lending requirements longer. So it's a lot has changed since, I suppose, the original max term to max age 75 products came out. But there's more and more lenders that are becoming more and more savvy, where you can go to these more golden years, shall we say. So there's options out there. It's just about, again, knowing who will take it to that term, or seeing if you can get something that's done outside of criteria. So yeah, and most landlords, as you mentioned on there, will have a property on an interest only basis and not capital repayment. We're probably seeing more and more people on a capital repayment basis to pass it down to children, grandchildren, etc. But ultimately, these older clients, there's still homes for them. And I'm not talking about nursing homes, I'm talking about lenders that'll ultimately be able to place a deal up to these later ages. It's just learning about and knowing where to place them.
What I would say, Harvey, is as lenders want to maintain the back book as originations become more sparse, and because of the good returns on buy-to-let, they will automatically increase that max age. We're now seeing it on residential. We're seeing lenders now, it used to be 65, then it's 68, then it's 70, then it's 75. We may see the new norm max term move into 80. So buy-to-let will evolve. Harvey's got one more question for you, Dan. Last one on the chat facility was, Dan, in your experience, are bridging lenders asking more questions and taking longer a deal than, say, 2 years ago?
Yes, I would say they're certainly taking a lot longer to get across the line than 2 years ago, but that's just because of legals taking a little bit longer and lenders being busier, to be honest. So whether that's a case of pre-COVID, a lot of lenders got rid of some of the staff, that they're not quite back to the levels that they were at, but business levels were higher than obviously pre-COVID. So there's finding that balance of service. Certainly the ones with the better rates are taking longer. So getting a bridge across the line in 4 weeks with your better lenders out there that have the better rates is achievable, but it's, again, not guaranteed. Asking more questions, I think they just tightened the belt a little bit, because we're seeing a lot more people that are defaulting on bridges, unfortunately, where there could be a bridging prisoner, or they've not fully understood. Not that, that's a wrong way of wording it. They've not met the deadlines that they have wanted to, and a lot of that's coming down to exiting the bridging finance, whether it's sale and sales taking a little bit longer, because again, if you purchase a property and you've titled it, turned it, and you're flipping it, then the first time buyer or home move that's moving into it, there's been a lot more delays at the moment with third parties, whether that's solicitors getting a valuer out, more requirements from a term loan mortgage lender. But there's all these factors that are impacting clients defaulting on the bridges, because they're leaving it later to refinance or put the property for sale or get tradesmen in, because there's a lot of external factors there. So I'd say more and more questions are being asked, not a million, but it's just about the lender being more comfortable. But that's just going across the board, because if you look at term loans, the average term loan's up in terms of time scales for those to complete. And I think there's still backlog of cases, because the market is still very busy, really. As much as new business may have slowed down for some people, it's still a busy market out there. So we haven't seen a slowdown. The stock's obviously still low, and lenders are still busy, solicitors are still busy. We know what some solicitors can be like in terms of time scales. So yeah, but there's probably a few more questions that are asked, but it is taking that little bit longer. But there is still that speed available out there. So if it's a case you've got something that needs to get across the line in 2 days, 7 days, whatever, there's lenders out there. But sometimes you might pay a premium to get that not so much fast tracked, but across the line in that time scale. But anything's still possible. We're still doing deals where they're complete in 24, 48 hours. Again, it's just about knowing and utilising your allies. I know I keep banging on about it and mentioning it, but it's just who you have in the corner and what favours you can call in at the final hour when a deal needs to complete quickly. And we've seen loads of auction purchases where a client, broker, whatever, has gone to a lender. Can you do it? Yep. Right. We've got a 28-day clause. Yep. Fine. Get to 20 days. We can't do it. We're not going to be able to complete in that time scale. Say bye-bye to your deposit. They've come to us and we've pulled that rabbit out of that hat. So again, it's just about the contacts you've got in which firm. So yeah, utilise the people around you.
Right, so we've come to the end of the questions. John, it's the wrap-up time now because David will be saying we'll be running over. Do you want to give your wise words of wisdoms to how you want to summarise and finish off today?
Today, I think we're talking about interest as costs and looking at that. I'll just reiterate, tax is a cost. Look at your structures plan. Don't stick your head in the sand. Otherwise, you'll find yourself potentially in an unaffordable position. Make sure you structure before you take any action.
Dan, what's your wise words?
Take a guess. It's just going to be utilise the people around you, partner up with a specialist like ourselves. Doesn't have to be us, but like ourselves, that can help you navigate the specialist market, earn as much, if not more, than you did last year. Diversify your client bank and your product offering, and just whatever help you need, ask for it. Whatever education you want, ask for it. There's plenty of people out there like ourselves that are happy to educate in the areas that you're not sure about. Again, these sessions aren't a plug for us, for our businesses. It's just 3 individuals with a number of people asking questions, educating about the market. It's as simple as that. But yeah, just use the people around you as best as you can.
And my closing words, and it's not a plug to Tandem, but it is a question of
The Coventry?
No, it's not the Coventry, but it might go back to Tandem. Guys, make sure that within your allocated week, you spend a percentage of your time communicating with your customers. That's a first. So create a newsletter, create a digital presence, and be able to keep them updated when it comes to being able to make them aware what's going on with the economy, what's going on with interest rates, the simple things that you think everyone will know, they don't know. Think about spending at least once a week doing a Teams call with a new lender. So if you haven't registered with Tandem, you haven't had a chat with Mark or David, then please go on the website and just register and we'll give you a ring. It's part of that automated process. And be active. If you're spending most of your time on product transfers, then find ways of communicating with customers, because the average transactions hasn't dramatically reduced, but it's about getting you back in that selling mode, because the last couple of years you were just flooded with new inquiries. It's about restructuring the business. So thank you for listening today. Dan, you do the closing words, and I'll leave it to you.
Are you sure? Because you've hijacked the rest of this session. So why not hijack this part? No, thank you very much, gents, for both of you coming on. Rog, nice, easy session for you. I've enjoyed being a panelist rather than the host. So yeah, but hopefully everybody found it useful. We will be doing this session again in October, so beginning of October, date to be announced. I just want to give a shout out to Dave, our marketing manager, who sits silently in the background. He does amazing to organise these sessions, get us 3 hooked and on. So thank you very much, Dave, for making these possible, really. But no, thank you, everybody. Let's stick together. We've had a lot thrown at us through the last few years. It's only going to continue, it really is. But as long as we stick together, we use the people around us, and as Roger says, we don't bury our head in the sand, then we'll get through it. It's what we do. We're having to work a little bit harder for our money, but we're adding more and more value each and every day. So any questions anyone's got, please get in touch with us after the session. But I wish you all a great August, great September, and we will see you again in Q4. How scary is that? But thanks for watching. Have a great day, and we'll speak to you soon.
Bye, guys.
Bye-bye.